You think you are building wealth. In reality, you are setting your future on fire. Last year we told you what to buy. We gave you the blueprint to start. But the game has changed. January 2026 wasn't just a new year. It was a massacre. The rules of money that your father taught you, they didn't just break. They were deleted. Right now, as you watch this video, your portfolio is bleeding. You don't see it because the numbers in your bank account look the same. But that is the trap. The purchasing power of those numbers is melting faster than you can earn them. The assets you feel proud of, your house, your car, your degree, are actually liabilities in disguise. The middle class is being hunted. The government, the banks, and the corporations have engineered a perfect storm to transfer your liquidity into their profits. They need you to stay in debt. They need you to buy things that lose value. They need you to believe that a 6% return is good when inflation is 12%. Today, we stop the bleeding. We are not adding to your portfolio. We are performing surgery. I have identified 5 specific assets that you must sell, liquidate, or avoid at all costs in 2026. If you own number 3, you are already losing money every single morning. Let's begin the purge. Let's start with the asset that was supposed to save you money. The electric vehicle. In 2024, they sold you a dream. Buy an EV, they said. Petrol is expensive. The government will give you subsidies. You are saving the planet. You did the math. 1 rupee per kilometer versus 10 rupees for petrol. It felt like free money. But here is the math they hid from you. Depreciation. In February 2026, the data is out. A petrol car loses about 20% of its value in 2 years. But an EV, it loses 42%. If you bought a Nexon EV or an MGZS in 2024, you haven't saved on petrol. You have lost nearly 7 lakhs rupees in pure asset value. That is 30,000 rupees vanished every single month. Why is the market rejecting your car? Because of the battery bomb. The battery is 40% of the car's cost. And unlike an engine that can be repaired for cheap, a battery pack is a use and throw component. Look at these numbers. A replacement battery for a mass-market EV in India now costs between 5.5 lakhs rupees and 8 lakhs rupees. Who will buy your 5-year-old EV when they know a 7 lakh rupee bill is waiting for them? And it gets worse. The insurance companies have woken up. In FY26, EV insurance premiums have spiked by nearly 200% compared to petrol cars. Why? Because a minor dent on the underbody isn't a repair. It's a total loss risk for the battery. You are paying luxury car insurance rates for a compact SUV. Here is the brutal truth. An EV is not a car. It is a gadget. A 10-year-old Toyota Innova is an asset. It runs, it has demand, it holds value. A 10-year-old EV is e-waste. The technology moves too fast. The 2026 models have solid-state batteries and 800 kilometers range. Your 2024 model with 300 kilometers range. It is the iPhone 4 in a world of iPhone 17es. Obsolete. If you already own one, drive it into the ground. But do not, I repeat, do not buy a second-hand EV thinking it's a bargain. It is a trap. And if you are planning to buy a new one on EMI, don't. You are financing a depreciating liability that will be worth 0 before you pay off the loan. That was trap number 1. But trap number 2, this one is sitting in your bank account right now, believing it is safe. Now, let's talk about the asset you trust the most, the one your parents swore by, the fixed deposit. You think it's safe because the principal amount doesn't go down. But in 2026, safety has a new definition. In February 2026, the RBI held the repo rate at 5.25%. This means the era of high FD interest is over. Your bank is offering you, what? 6.8%, maybe 7% if you are lucky. Now, let me show you the math that makes you poor. The government doesn't want you to save cash. In the FY26 rules, if you earn more than 50,000 rupees in interest, the TDS cuts in automatically. If you are in the 30% tax bracket, your 7% return instantly becomes 4.9%. Now subtract inflation. The government says inflation is 2.75%. But look at your bills. Education, up 10%. Healthcare, up 14%. Your personal inflation is at least 8%. 4.9% minus 8% equals negative 3.1%. This is what I call the silent thief. Every year you keep money in an FD, you can buy less than you could the year before. You aren't preserving wealth. You are slowly freezing it to death. FDs are for emergency funds. They are not for investment. If you have more than 6 months of expenses sitting in an FD, you are not being prudent. You are being lazy. The rich do not use FDs. They use liquid funds for safety and gold for hedging. While your money slept in the bank, gold hit new highs in 2026. The difference: gold fights inflation. FDs surrender to it. Stop treating the bank like a temple. It is a business, and you are the product. Limit your FDs to exactly 6 months of expenses, not a rupee more. Liquidity is good. Lethargy is fatal. But if you think FDs are a bad deal, wait until you see trap number 3. This is the one that destroys the Indian middle-class dream permanently.
Trap number 3. The Holy Grail. Your own house. For 50 years, this was the ultimate symbol of success in India. But in 2026, the dream home has become the debt tomb. Let's look at the math that builders pray you never see. In major cities like Mumbai and Bangalore, the rental yield, the money your house actually earns, is stuck at 2% to 3%. But your home loan interest, that is 8.5%. Do you see the gap? You are paying the bank 5% more every year than the asset is worth. You aren't an investor. You are a donor. But the financial loss isn't the worst part. The worst part is the opportunity cost. To buy a 1 crore rupee flat in 2026, you are paying an EMI of 85,000 rupees. That EMI is a shackle. It means you cannot quit the job you hate. You cannot start a business. You cannot take risks. You have traded your freedom for a box of concrete that you don't even own. The bank does. And if you think, but Adam, the price will go up. Look at the inventory. As of 2026, there are over 5.7 lakh unsold units in top cities. Builders are sitting on mountains of empty homes. The appreciation you are betting on. It's a myth fueled by marketing. In real terms, after inflation and interest, real estate in Tier 1 cities is flatlining. So what is the solution? Rent. Rent the lifestyle you want for 35,000 rupees. Invest the remaining 50,000 rupees in assets that actually grow. Gold, index funds, Bitcoin. In 10 years, the renter will have a portfolio worth crores. The buyer will just have a house that needs painting. Unless you have 100% cash or you are settling down for retirement, do not buy a house in your 20s or 30s. Sell the dream. Buy your freedom. Now, trap number 4. This is the one that hurts the most because it attacks your emotions. Trap number 4. The one they sell you using your fear. Insurance disguised as investment. Every uncle in India will tell you, buy an endowment plan. It is safe. It is for your family. But in 2026, let's look at the real numbers. These traditional plans give you a return of 5% to 6%. But medical inflation in India is running at 14%. Education inflation is 12%. By locking your money here for 20 years, you are guaranteeing that you will be poorer when the policy matures. You are not protecting your family. You are funding the insurance company's skyscrapers. The rule is simple. Never mix insurance with investment. Buy a term plan for protection. Invest the rest in the market. If you have an endowment plan that is less than 3 years old, surrender it. The loss you take today is cheaper than the inflation loss you will take over 20 years. And finally, trap number 5, the get-rich-quick lie.
Small cap mutual funds. In January 2026, the bubble finally popped. Funds like Quant Small Cap and Nippon Small Cap saw liquidity stress. The SEBI stress test results are out. It would take some funds 60 days to liquidate their portfolio. This is the liquidity trap. When the market falls, you cannot get out because there are no buyers. If you have more than 20% of your portfolio in small caps, you are gambling, not investing. Shift to large caps or index funds immediately. The party is over. This is your surgery. 1. Sell the EV myth. 2. Break the FD addiction. 3. Rent. Don't buy. 4. Surrender the bad policies. 5. Exit the small cap hype. It will hurt today, but in 10 years, when your friends are drowning in debt, you will be free. Now that you have cleaned the trash, what do you buy? Click here to watch the 9 assets the rich buy. Class dismissed.